How does the market's risk-reward profile look heading into the last week of the year? To answer that question, we'll review the hard, unbiased, and binary evidence. As we head into the last week of the trading year, if you asked me, Chris, what do you think about the stock market? I would say it doesn't matter what I think. It matters what the market thinks, since the market sets asset prices. In this week's video, we'll look at the strength of the S&P 500's weekly trend. We'll answer the question, would I rather be long or would I rather be short? Would I rather be in stocks or would I rather be in bonds? Should I be chasing yield or should I be more concerned about safety of principal? The charts say what they say until they don't say it anymore. Therefore, it's important that we maintain maximum flexibility. The charts say something today. That doesn't necessarily mean that's what they'll say tomorrow. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. This is a weekly chart of the S&P 500 index used in the CCM market model. This is 2010. This is August of 2013. What we'll do for this chart and the three that follow is look at a bearish setup, a bullish setup, and then we'll see what today looks like. Arguably, the most important thing relative to prudently protecting and growing our capital is discerning between volatility to ignore, volatility to ignore, volatility to ignore, and volatility to respect. This is the S&P 500 here, the dotted line. We use a fast moving average, which is the blue moving average, and a slower moving average, which is the red moving average. A bullish look is price above blue and red, blue above red, and both of the slopes up. The probability of good things happening increases when we get that bullish look. The probability of bad things happening increases when we get the mirror image, which is price below blue and red, blue below red, and the slopes are down. This is a full bore bullish look, and this is a full bore bearish look. We can also use momentum. When Williams percent R, or weekly momentum, is strong and in overbought territory, the probability of good things happening increases. When you drop out of overbought territory on a closing basis, on a weekly chart, the probability of bad things happening increases. This is a good look. This is a bearish look. What does today look like? As of the close on Friday, December 27th, we clearly have a bullish look with price above blue and red, blue above red, and the slopes are up. We also have no yellow flags in the momentum department. The market model and this chart do not predict anything. As long as we maintain the bullish look, it checks bullish boxes in the market model. When we have a bullish look, we allocate accordingly. When we morph into a bearish look, we reduce risk accordingly. Very similar concepts here. Now we're looking at a weekly chart of being long the S&P 500 relative to being short. This is a risk on versus risk off chart. I'm confident versus I'm fearful, or long versus short. It helps us answer the question, would I rather be long stocks or short stocks? This is what I'd rather be long looks like. The probability of good things happening increases. And this is what I'd rather be short looks like here, with a full bore bearish look, and the probability of bad things happening increases. The market model also tracks weekly momentum. The probability of good things happening increases when we're in overbought territory, and the probability of bad things happening increases when we drop out of overbought territory as we did here. What is this chart telling us today? It's telling us from a probabilistic perspective, I'd rather be long as of the close on Friday, December 27th. We have price above blue and red, blue above red, and the slopes of both are up. We also have momentum remaining in bullish and overbought territory. As long as the market continues to look this way, it will check bullish boxes in the CCM market model, and we will allocate accordingly. If it morphs into a look like this, or this, where declines in the stock market followed, we will begin to incrementally reduce risk. This is another weekly risk-on versus risk-off ratio used in the CCM market model. We're looking at the S&P 500 relative to the aggregate bond market, or the AGG ETF. You can think of this as risk-on versus risk-off. This is what risk-on looks like. This is what risk-off looks like. I am confident versus I am fearful, or simply stocks versus bonds. When I'm confident about the future, I'd prefer to be in growth-oriented stocks. When I'm concerned, I'd prefer to be in defensive and principal-protecting bonds. This is our full-bore bearish look here. Price below blue and red, blue below red, and the slopes of both are down. The odds of bad things happening in the stock market increase under those conditions. Here's my full-bore bullish look. The probability of good things happening in the stock market increase when we have this profile. This is the S&P 500 here, shown for reference purposes only. Get the bearish cross here, the odds of bad things happening increase. Bearish cross here, full bore bearish look, the odds of bad things happening increase. Conversely, full bore bullish look here, blue above red, price above both, and the slopes of both are up. The odds of good things happening in the stock market increase. What is this chart telling us now? This ratio helps us answer the question, would I rather be in stocks, or would I rather be in bonds? And as of the close on Friday, December 27th, 2013, the answer is clearly, I would rather be in stocks. Price above both moving averages, blue above red, and the slopes of both are up. As long as it continues to look like this, it will check bullish boxes in the CCM market model, and we will allocate accordingly. If it morphs into something like this, or this, or this, where weakness in the stock market followed, we will begin to reduce risk at a rate in line with the observable deterioration. Since it has a lower correlation to the S&P 500 index, this risk-on versus risk-off ratio carries a lower weight in the CCM market model. It's helpful. It's just not as helpful as the three previous charts and or risk-on versus risk-off ratios. We're looking at JNK, junk bonds relative to conservative treasury bonds. Yield versus safety of principles, another way to look at it. I am confident I will get paid versus I'm nervous about defaults. This is what I'm confident I'll get paid back looks like. This is what I'm nervous about defaults looks like. You can see when we get a full bore bullish look, price above both moving averages, blue above red, and the slopes up, the probability of good things happening in the stock market increases. And conversely, when we get a full bore bearish look, price below both moving averages, blue below red, and the slopes down, the probability of bad things happening in the stock market increases. What is this ratio telling us today? It's telling us the market is not particularly concerned about defaults, and they'd prefer to chase yield. We have a full bore bullish look as of the close on Friday, December 27th. Price above both moving averages, blue above red, and the slopes of both are up. As long as it maintains this look, it will check bullish boxes in the CCM market model. If this morphs into something that looks more like this, or weakness in the S&P 500 followed, we'll begin to reduce risk in an incremental fashion in line with the observable evidence. The previous 4 charts and/or ratios are just a sample of what the market model uses to assess risk. We also look at multiple time frames, daily, weekly, monthly. We look at indicators as well as ratios and price. And ultimately we ask, does this only occur in bull markets? Does it only occur in bear markets? Or does it not help us discern between the two? Does this only occur during stock market rallies? Does it only occur during stock market corrections? Or does it not help us discern between the two? We can convert all of this to a mathematical score. How do we track all of this information and convert it into a usable format? These are screenshots where we answer the binary questions. Is the slope of the blue moving average positive? Is the slope of the red moving average positive? These are all of the questions that we just looked at on the weekly charts. If the answer is no, it's a 0. If the answer is yes, it's a 1. We also look at hard data, which is unbiased, and we use bullish and bearish hurdles. All of this is used to get a handle on the current market profile and/or tolerance for risk. This is observable, hard evidence that helps us understand what the current market profile looks like, and then the master market model compares it to historical profiles and recommends an exposure to risk assets such as stocks and conservative assets such as bonds. The rationale for building the market model is we need to be able to handle extreme cases. For example, from December of 2013, if the stock market rises for another 3 years, as it did from 1997 to the peak of the dot-com bust in 2000, it was a 91% gain from point A to point B. We want to be able to handle that. With central banks around the globe printing money in a simultaneous manner never seen before, it's only a matter of time before a bull market turns into a bear market, So we also have to be able to handle case B, where the stock market loses roughly 50%. The market model allows us to handle case A or case B by monitoring and tracking and converting the observable evidence into a prudent allocation. This is the master market model spreadsheet. Those of you that follow the markets closely remember the S&P 500 bottomed or made an intermediate term bottom on October 9th of this year. You can see the model was recommending only a 41% exposure to risk assets. And then as the observable evidence improved, it allowed us to quickly scale back towards a higher allocation to stocks. We had a little scare recently from about December 10th until December 17th. Then the observable evidence quickly improved, allowing us to scale back towards a full allocation to stocks. You can find more information about the market model on our website. You can also follow us on Twitter, Facebook, and YouTube. We also provide daily updates on our blog, Short Takes. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.